Welcome back to this week's market update. Today is Monday, November 3rd, 2025, and we'll jump right in. It was another week of limited economic data as the government shutdown officially reached the 1 month mark, halting key releases such as PCE inflation and personal income data that typically comes out at the end of the month. Despite this, though, we did have a Federal Reserve meeting where the Fed announced a 25 basis point rate cut, as well as quite a few corporate earnings reports coming out last week. Accordingly, markets ended the month of October on a positive note, with the Nasdaq Composite leading up 2.24% last week, followed by both the Dow and the S&P 500 up about 0.75% last week. Moving into some economic updates, as I mentioned, the Federal Reserve met last week and cut rates for the second time this year, lowering the federal funds rate by another 25 basis points to a range of 3.75 to 4%. You can see the upper limit right here. The Fed also announced plans to end quantitative tightening of its balance sheet on December 1st. So, two pretty significant moves towards more of a stance of QE, still fairly restrictive at 4%, but moving into a more accommodative stance. One notable surprise of the meeting came while Jerome Powell was speaking, as he appeared significantly less confident about another rate cut in December, which markets had previously viewed as a near certainty, but now only see as a modestly likely scenario. The S&P 500 was flat on Wednesday last week following the meeting, reflecting the muted reaction to this expected October rate cut, but the lower odds of a rate cut in December as well. Looking at some earnings that we got last week, we did have 5 of the Mag 7 reporting. You can see why this is such a big deal when you look at their weight as a percent of the S&P 500. So nearly a quarter of the S&P 500 is made up of these 5 companies. So hence why we really want to take a look at how their earnings and how their underlying fundamentals are doing. You can see we had quite a bit of dispersion in the stock prices, and the stock prices reflect a lot of the fundamentals going on within the company in the near term. So looking at each stock here, Microsoft beat earnings and revenue expectations, but shares slipped ever so slightly, just shy of 1%, as investors focused on higher AI-related spending. Google posted its first ever $100 billion revenue quarter, boosting confidence in its AI leadership and sending shares more than 8% higher for the week. Meta had pretty strong sales but fell more than 12% last week over rising AI expenses and a large one-time tax charge. Apple delivered strong results and upbeat holiday guidance, with services driving a pretty strong but modest 2.9% gain over the past week. And then last but not least, Amazon topped expectations, also posted some really strong cloud growth. So you can see that was up nearly 9% over the past week. Overall, I'd say a key takeaway from last week was the growing potential for AI monetization, alongside the risks of rising expenses and capital needs needed to build out the AI infrastructure. So investors are really hoping to have companies strike that perfect balance between monetizing their current technologies as well as investing for the future. Panning back a little bit at the Mag 7, or at least the 5 that reported last week, you can see a lot of dispersion between the returns. Google has really taken away in the last few months, up more than 48% year to date. The rest in a more modest range here, but Microsoft definitely leading the pack there at nearly a 23% return year to date. Last but not least, beyond the Fed meeting and corporate earnings, we also got the Consumer Confidence Index for the month of October, holding steady but falling ever so slightly to 94.6. Stronger views on current business and job conditions helped offset softer expectations for the months ahead. Inflation remains top of mind, with the 1-year inflation expectations rising to nearly 6%, and more than half of consumers expecting higher interest rates. Confidence was strongest among middle-aged and higher-income households, while younger and lower-income groups grew more cautious. As the holidays approach, spending plans are pretty mixed. Many consumers are reporting that they are prioritizing value in deals, keeping sentiment stable, but overall pretty subdued. As you can see, we've been trending ever so slightly lower in the past 4 or 5 years in both the present situations and the expectations indexes. So that concludes this week's market update. It was still pretty busy despite the lack of government economic data, but we really appreciate you tuning in and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.